What is an everything bubble, and what happens if it pops? The everything bubble is a term that has gained traction in economic discussions, particularly concerning concerns about financial stability and the potential for widespread market corrections. This phenomenon involves the simultaneous inflation of asset prices across multiple sectors, including stocks, real estate, bonds, and even alternative assets like cryptocurrencies and collectibles. The term suggests an overvaluation of a broad range of assets fueled by prolonged low interest rates, excessive liquidity provided by central banks, and speculative investment behavior. Origins of the everything bubble. Low interest rates. Central banks worldwide, especially the Federal Reserve, have maintained low interest rates for an extended period. This monetary policy, initially aimed at stimulating economic growth post-2008 financial crisis, has made borrowing cheaper, encouraging individuals and corporations to take on more debt. Quantitative easing. In addition to low rates, quantitative easing, where central banks purchase large amounts of securities to inject liquidity into the economy, has significantly increased the money supply, fueling asset price inflation. Speculative investments. The low-yield environment has pushed investors to seek higher returns in riskier assets, leading to speculative bubbles in sectors like technology stocks, cryptocurrencies, and even non-traditional investments like digital art. Why it's concerning. Systemic risk. The everything bubble poses a systemic risk to the global economy. If one asset class experiences a significant correction, it could trigger a chain reaction affecting other overvalued sectors, leading to a broad market downturn. Debt vulnerability. The bubble coexists with high debt levels. If asset prices fall, it could lead to defaults and a tightening of credit conditions, particularly damaging for highly leveraged companies and individuals. Retirement savings at risk. Many retirement portfolios contain assets with inflated prices. A market correction could severely impact the savings of millions, with little time for recovery for those near retirement. Economic inequality. The inflation of asset prices disproportionately benefits the wealthy, who are more likely to own these assets, exacerbating economic inequality. A burst of the bubble could harm lower-income individuals more severely, as they are less equipped to handle economic downturns. Policy dilemma. Central banks face a tricky balancing act. Raising interest rates to temper asset inflation could choke economic growth and increase the debt burden, while keeping rates low may further inflate the bubble. Potential outcomes. Gradual deflation. Ideally, a gradual deflation of the bubble, facilitated by careful monetary policy and market adjustments, would minimize economic disruption. Abrupt burst. A sudden burst of the bubble, possibly triggered by an external shock or rapid changes in monetary policy, could lead to a severe economic downturn. Transformation of investment patterns. In the long term, the bubble might prompt a shift in investment strategies, emphasizing value and fundamentals over speculative growth. Conclusion. The everything bubble represents a unique challenge in the economic landscape. Its implications are vast, spanning financial stability, wealth inequality, and personal finance. Navigating this bubble requires a delicate balance of monetary policy, fiscal initiatives, and individual investment prudence. While the future is uncertain, understanding the dynamics of this phenomenon is crucial for preparing for potential outcomes.